Hey everyone, it's Dave Barnett from the investlocalbook.com blog site, and I'm back with another viewer question. This one is from Sam in Orlando. And what Sam says is, I am currently going through several acquisitions and sometimes need financing for non-core aspects, such as lines of credit or bridge financing. But the financing has to act like equity in order to enhance my ratios. Where should I go to find these non-conventional financing methods? Well, first of all, let's take a little step back so that the rest of the audience can follow along, Sam. What Sam is talking about when he talks about his ratios is he's talking about his debt to equity ratio. So this is a balance sheet. And on a balance sheet, on the left-hand side, we have assets. And sometimes these are stacked on top of each other. But we've got assets, we have liabilities. These are your debts. And we have equity. This is what you own. So let's imagine a fictitious company here. Let's say this is Sam's company, and over here he has $120,000 worth of stuff. And over here under liabilities, he has $90,000 worth of debts and $30,000 worth of equity. Balance sheets always add up. They always balance. So we have 120 over here. 90 plus 30 equals 120 as well. So our balance sheet is balanced. So Sam goes to the bank and he says, I want to buy another company. And they look at his balance sheet and they say, this is great, Sam, because you have a debt to equity ratio of 3 to 1. So for every $3 of debt you have $1 of equity. That gives us a 3 to 1 debt to equity ratio, which is what the bank likes to see. Anything 3 to 1 or lower, the company is probably considered to be quite strong. If it's up above 4, then it would indicate danger to the banker. Too much debt, too much leverage. Not enough skin in the game on the part of the owners. So let's say that Sam goes out and he says, I want to buy another company which costs $60, and I want to borrow all the money to do that. That would mean we'd be adding 60 here, giving us 180. And if we add 60 here, that gives us 150. But our equity hasn't changed. So now we have a debt to equity of $5 of debt for every $1 of equity. This is too risky. So the bank says, we're not going to lend you $60 to make this acquisition. So what Sam is asking is, where can I go and find money to buy this acquisition, this $60 that I need, but it's going to fit down here even though I don't have the money. So let's make a little adjustment to our purchase. Let's say that Sam then comes back to the bank and he says, okay, I still need to find $60 to buy these assets. So what I'd like to do, Mr. Banker, is I'd like to borrow 30 from you, and I'm going to get another 30 of equity somewhere else. So now we have 60 of equity and 150. Sorry, we reduced that. We have 120 of debt. So what has this done to the company is we now have $2 of debt for every $1 of equity. See how things have changed? This is now a very strong company. Okay? So sometimes if you're going to make an acquisition, you're going to add to the assets, you need to find more ways to add to equity down here. Now Sam's specific question is, where can I find this type of equity financing if I don't have the money myself? And basically there are a couple of different sources. So basically Sam's question is, how do I go about finding additional source of financing like this $30 when I don't have it myself? The banker needs to be able to consider it as equity and not as debt. If we look at the right-hand side of the balance sheet, we have liabilities, debt, and we have equity. We could say that it's black and white. The reality is that there are shades of gray. There are different types of things that we can put on the balance sheet that bankers might consider to be either equity or debt, depending on the features of those financing tools. So for example, you could have another class of shares down here, what we call a preferred share. And preferred shares usually have a face value, for example, $100, and they usually have an interest rate or a coupon attached to them, let's say $10 a year. So that would be a 10% preferred share. Now, if that debt instruments contract, so to speak, is written such that the company must pay the interest every year, even though it's called a share, the banker is going to consider it debt because that $10 payment has to be made every year. It acts like debt. It creates a negative impact on the cash flow. But if that preferred share was what we call cumulative, meaning that if the company couldn't afford the cash to pay out the dividend, they didn't have to, and it simply became a dividend payable or due to those shareholders, then the banker may consider it equity, because if there's a cash flow crunch, those shareholders don't need to be paid according to the contract that was used to set up that preferred share. Likewise, we can have versions of debt that act like equity, what we call subordinated debt. So subordinated debt basically says we're behind everyone else. If there's ever a bankruptcy or anything, we're likely going to get nothing. And they could have payment schedules associated with them that are much like strip bonds. So a strip bond doesn't have a coupon attached to it. So for instance, you could have a loan that simply says this loan accrues interest at a certain rate, but nothing has to be paid on it for 5 years or 10 years or something like that. So in that case, because there's no cash flow impact, you might be able to convince a banker that that debt is actually equity because it acts like equity. So where do you go to find these kinds of things? Where do you go to find people who are willing to buy preferred shares or institutions that are willing to create subordinated debt deals? Basically, on the institutional level, you're talking about private equity firms. So these are basically companies or corporations, private banks almost, that go looking for these high-yielding, high-risk deals, and they want to be paid. So in that kind of situation, you're probably going to be looking at interest rates of 18% or more, plus even what they call equity kickers. So they might be out there looking for opportunities to help people grow a business with the idea that the business is going to be sold at a certain point in the future, and they may even want a portion of the equity at the time of sale to further enhance the rate of return. Your preferred shares and other kinds of instruments like that are going to be sold to people you know. It's very difficult for a private business to go and create a prospectus and attract investment from the public in something like that. You're going to have to go out and find people that you know that are willing to invest with you and actually enhance the equity of your balance sheet by really contributing equity, so adding shareholders, either as common shareholders or some kind of preferred shareholder. Now, it's not just finding people who may want to put money in. The other way that you can do this, if you're specifically going to be acquiring other businesses, is you can make a variation on the vendor take-back loan theme. I've done a lot of different videos on vendor financing when you buy a business. You could go to a business and instead of saying to them, Mr. Seller, I'll give you 75% of the money on closing if you will finance the other 25%, you could say, Mr. Seller, I will pay you 75% of the purchase price in cash, and I'll pay the other 25% by giving you convertible bonds or Class B preferred shares or a subordinated debt instrument in my main acquiring company. So that creates a different kind of negotiation. And in fact, that sort of thinking is what the big guys do. You often hear in the financial press that one company is taking over another company, and they'll say, in a cash and share deal, which literally means that part of the purchase price is being done in cash and the other part of the purchase price is being done by giving shares to the shareholders of the company being acquired. So those are some ideas of what you can do. Maybe that will give you some ideas of some resources you can get access to. For more specific help into your circumstance though, Sam, I would suggest that you arrange for a call with me because I can discuss in detail the specifics of your situation and maybe offer some other ideas that might work in your particular circumstances. Thanks, that's it for today, and we'll see you later.
Hey, you made it to the end of the video. That's great. Don't forget, visit www.investlocalbook.com. Sign up for my email list. It's right down here under the welcome video. Thanks, and we'll see you next time.